Farm4Profit Podcast. Take a listen, have a blast. Farm4Profit Podcast. Learn about farming while having a laugh. Farm4Profit Podcast.
Here we are, Commodity Classic 2024, sitting again in the largest booth Commodity Classic has ever seen.
Yes.
A beautiful sea of green and yellow.
It's huge.
Huge. I tell you what, I hope out of this conversation we get to see a lot more green in our future.
Oh, yeah.
Oh,
yeah.
Maybe,
well played.
Maybe he's got other things that he's going to end up sharing with us. This is a repeat guest, and I'm happy to have David Widmar back on the podcast. Welcome back to a live and in-person interview.
Well, thank you so much for having me. Looking forward to the conversation.
So as we have this conversation, to remind our listeners, you are an agricultural economist specializing in ag trends and the farm economy. You are the co-founder of Ag Economic Insights, which you did clear back in 2014, the same year Farm4Profit started. And you're a researcher with the Department of Agricultural Economics at Purdue.
Formerly.
Oh, look at that.
Formerly. So, yeah.
It does say prior. I should look at my own notes.
It does say prior.
Spent a lot of my career at Purdue, but with Ag Economic Insights now full-time. So, great to join you guys.
Absolutely. So let's talk about what you're doing down here at Commodity Classic. What's on your agenda?
Well, we have AEI has a booth where we're talking about all of our services and the work that we do, but also joining here on Friday afternoon for a panel conversation around interest rates and the farm economy and how can producers begin to position themselves in light of this new interest rate environment. You know, as Warren Buffett says, interest rates power everything in the economic universe, and so that's a pretty tall order. So how do we start thinking about that at the farm level?
Where are interest rates going then?
Well, I think the first thing to think about is we probably shouldn't be trying to outguess the Federal Reserve or outguess where inflation is going. One of the things to recognize is that I think it's really important is the disconnect between long-term and short-term rates. And we have a lot of focus and attention on where the Fed's going to go in the next year or 3 months. You know, there's almost like a Fed countdown when they have their meetings. But I think a lot of producers, it's those 10-year treasuries that are more important to watch. And so right now we see this yield curve inversion. Okay. And one way to think about this is that long-term rates didn't increase as fast as short-term rates did behind us. So what's going to happen in the next year or 18 months, maybe as the Fed lowers short-term rates, we could see some stickiness in these long-term rates as that yield curve uninverts itself or goes back to more of a normal. So I've been trying to encourage producers, let's not try to outguess the Fed. Let's think about our operation, long-term rates, and how we can position ourselves in light of that.
Well, and as producers, do we try and guess? Or, I mean, everybody makes educated decisions. So we're just like we make educated decisions on what seed to buy and how wet of a year we think it's going to be. I mean, we all try to make the best decision making based on data-driven decisions. So is there data that suggests that it's a presidential year, maybe we should be more cautious? Hey, it's repeated history from the 80s. It's done this. I mean, is there, although we're not trying to guess, is there a trend?
Well, I think it's very important for us to be very transparent with ourselves and maybe with our partners or our trusted advisors or our business partners what our expectations are. So maybe it's valid to say, what's the probability of 10-year treasuries getting above 6 percentage points or 6% in 2024? That's something that, and we've spent a lot of time thinking about the farm management side. How can we help producers be more specific about these uncertainties and how we think about it and how we converse about them? So you can set your own threshold. We have some thresholds that we keep an eye on. But the idea here is, now that you think about those expectations, do I think it's a small probability of happening or a big probability of happening? And that starts to maybe impact those decisions. If you're really worried about these large changes in interest rates, especially to the upside, you might want to start locking these rates in. If you think there's more downside than upside, and I think the other part here, to build off your point, we have to recognize when our expectations aren't valid anymore. So it's one thing to be wrong, but how quickly can we adjust when we realize that we're wrong? So it's not just betting against the market, it's updating our thinking when the information contrary to what our expectations were gets revealed.
Yeah, so it's kind of a touchy subject for a lot of our listeners, because when you said long-term rates may be sticky, well, they still might also be going up as you see short-term rates coming down. And that's one of those battles that is going to affect some major asset classes in farming.
Right. Sticky is, I guess, one way of saying it. They could go up even as the Fed lowers short-term rates. We've looked at this. What's that relationship between short-term and long-term rates? It depends on how you measure that, but there's maybe 100 basis points or 150 basis points that it could drift higher relative to those short-term rates. So yeah, there's a lot of upside there. Again, we just don't live through very many of these times in our career. In the 1980s was the last time we saw rising interest rates, and we've been in this downward trend since the mid-1980s. And so we got to recognize that the decisions and the rules of thumb maybe that we've been using for the last 3 or 4 decades might not be as applicable here. We're not only in a higher interest rate environment, we're in a very unstable interest rate environment. There's a lot of uncertainty. If you think about the last 2010 to 2020, it was a low interest rate environment. Everyone focused on that, but it was very, very stable, and we're not in either of those situations today. So, going back to David's point, I think it's this uncertainty that's almost as important as the magnitude.
So when we talked last, it was because you had a podcast that you released comparing what the economic conditions were at that time to the 80s. Now that we're 2 or 3 years removed from when you originally put that out, how do you feel the comparison of today is to then?
Well, that's a great question. It's one that we get asked a lot, and I could spend my entire career just sort of revisiting this. Is this the 1980s? That's a question that we get asked a lot. One of the key differences that keeps coming up is that we have a lot more of the farm debt out there today that's on real estate. So that's more likely to be fixed terms, long maturity or long repayment. So that helps a lot in this situation. One of the similarities is this rising interest rate environment, this concern around inflation. And I think we're a little early in the inflation battle to really know, have we got it wrapped up, or is there still more time to be fleshed out in that concern?
I was at the Land Expo and talked with Farm Credit and one of their higher-ups there, and he gets to talk with the Federal Reserve, which us as farmers maybe don't get to talk with the feds down in Kansas City or wherever. And I always say markets are emotion. So I just want to know, what was the emotion of the people that are making the decisions at the Federal Reserve to say, hey, what's their tenor? Do they feel that we have hedged inflation enough? Do they feel we need to go farther? And his comments were, they don't feel they've gone far enough, and that we haven't corrected inflation enough yet, and that basically we don't want to repeat the 80s, because I think in the 80s, it was like 79 or 81, we came back and we said, all right, we've corrected it, and we lowered it, and then all of a sudden it went back up the other way, and they're like, we do not want to repeat history there, so we're going to go even farther down the road of we have not corrected it yet until we know with certainty, then we'll back it up. You got thoughts on that?
I think it's a very good connection back to the 70s. There was this double dip. One of these things I like to point out here is
a W trend or something they called it.
Yeah. Interest throughout the 70s and early 80s. There was a 10-year period where inflation averaged 7.5% throughout the entire economy. So we saw a flash of that for a very brief moment here in the recent history. So I like to think about inflation's pain as the magnitude and the duration. And in the 70s, we had it in both flavors. The magnitude and duration was much different in the 70s. So the question that I have is, how long is this duration? And if we get back to 6 or 7%, that's going to start to feel, a lot of pain, especially if it's sustained. One of the things I think is really important for producers to keep an eye on is we hear Jay Powell give those comments after their rate hikes, and those are great to listen to. And then the media summarizes them. And after you read all this, you start to think oh yeah, they're going to lower interest rates 3 or 4 times in 2024. But the Fed also on a quarterly basis releases what they call the dot plot, or what I call the dot plot. And it's every individual participant's sharing of the Federal Open Market Committee where they think those rates are going to be. And all of a sudden you see this huge range of opinions. And it's not this consensus that we kind of think everyone unanimously agreed upon. There's a lot of disagreement, or not disagreement, there's differences of opinion. And I think to your point is they want to make sure inflation gets under control. And I think one of the hardest parts about inflation is that colloquial definition of it's too much money chasing too few goods. And a lot of times we talk about, it's the money supply, but in my mind, it's the chase. Why are people chasing things? And if you think about prior to 2020, the Fed was worried about not having enough inflation in the economy. The economy wasn't growing enough, and they started quantitative easing, and they were trying to get the economy to grow. We couldn't get enough of it. And now all of a sudden we have the chase. And when does that chase go back into the bottle? I don't know. Maybe we weren't going in the right direction, but the Fed is going to be on watch, and they're going to be vigilant to make sure that we don't see that. But going back to that 70s, because that was another example where we didn't get the chase put back in, and it created even more pain in the late 70s and early 80s.
So as you look at the state of the union for agriculture right now, how would you describe from your observations where ag is sitting?
Well, let's start by backing up and saying, where was the State of the Union in 2022? That's an easy one. That was probably the best year in most of our careers. If you want to be a farmer and you want to make a lot of money and you want to farm for profit and you also want to own some land, high farm profitability and 0% interest rates is the environment where you make a lot of money and asset values, farmland goes up a lot. And we saw that in both cases. And now we're in a situation where those tailwinds are now subsiding a little bit. And I'm not saying that they're full-on headwinds. We just don't have as much wind in those sails as we had back in 2022. So first off, we see net farm income declining. And a lot of headlines have been talked about how this is a 25% decline or whatever the magnitude is. But when we look at the data, we look at the long-run trends, it's a return to normal. The other piece here I think is really important, especially around asset values, is this rising interest rate environment. And that's, again, maybe a bit of a headwind, but it's not a full gale force. We don't see this crisis imminently around the corner. It's more of a return to more normal and what we should be expecting of. Again, 2022 is the anomaly. We don't have very many of those in our career.
And look at that, Corey. You had it early in your career.
9 years in. That's pretty early.
Hopefully pretty early.
We just need the good times to stick around longer because I didn't have enough time to update everything that we hadn't been doing for the last 8 years before that.
Yeah, that's the challenge with producers is we think about these cycles in agriculture, these good years, and there's not as many good years as we would like to see. You think about 100 years of farm income in the past, and those stable years that are the lean, we make some progress, but they're pretty lean. There's a long trough of those, too, that we got to slog through.
And these downtrends hurt the worst. Yeah, I can make money at $4 corn if all the inputs were priced at $4 corn and not, priced at, it was $5 last fall. And everyone was pricing them that way. So, and we book a lot of our stuff. So maybe that's bad on me, but.
And that's one of the things we like to remind producers about these cycles is what makes the boom so favorable is that the costs of production are slow to adjust. They're sticky, as we talked about earlier.
Yep.
And so the producers who can hold those costs of production low when the commodity prices are going up are going to enjoy more of that boom. But on the other side of the squeeze is those costs of production are slow to come down. So operations that can pull those cost structures lower. And there's a lot of different ways that can happen. But if we can lower our cost structure going from $5 corn to $4.50 today, and who knows where we're going to go a year or two from now, but how can we as producers make sure our cost structure is reflecting whatever that environment is that we're getting?
What suggestion do you have? So we're at Commodity Classic here. This entire, if I could sum it up, it's people making decisions. Do I buy this equipment? Should I try this new practice? Should I buy that new seed? Should I do this, do that? Everybody's making decisions, and we're Farm4Profit Podcast. We want you to be profitable in any decision making you have. And normally we say put a team around it, okay? So there's a huge team of all kinds of dealer partners that are here. Looking forward, how do we rebound or how do we make good decisions in the current environment? We know our inputs cost more. They haven't caught up. They're sticky. We know that our cost of production might be more than where our commodities are showing that we're going to get paid. So right now it looks like I lose $30,000 a year on an 80-acre field. How do we position ourselves to make money? You've studied this. What's your thoughts?
Well, I think the first piece is to focus on the levers that you can control, not the information around you that you can't control. So we have very little control over what Jay Powell's going to do with the interest rates, and we have very little control of where corn prices are going to go. Well, what do we have control on? We can think about how do I want to use debt in my operation today? What is the types of debt that I want to be using? What are the terms that I want to be using? Should I be using cash versus debt? That's a question I think is really important in this environment. The second one is know your cost of production, but take it one step further and know what you're going to do with that information. So should you be marketing? And I think with that know your cost of production, one piece I like to remind folks on is the fixed cost structure is the one that we often have the hardest time benchmarking and measuring. Why? We can't call somebody up and get a price for family living or our machinery expense across the entire enterprise, or even our land cost becomes very tricky to think about. What do I rent? What do I own? So those are hard to get a hold of, but they oftentimes are a majority of our total expense. Those three categories are about 60%. But the last piece is they're very predictable. So if we can actually measure them and benchmark them and put in an SOP to measure that and update it every year, we can know what our family living is going to be 3 or 4 or 5 years from now. If, it's going to change if we make decisions, but these are things that are actually very plannable. So in this environment, I always encourage producers, know those fixed costs, plan them out for several years, and then you can start to do some scenario analysis. If we go to $4 corn, $3.75, which one of these costs can I pull the lever on, and how quickly can I do it?
If I can control the lever, first thing you said was debt, okay? If I can control the lever and say, hey, I could sell this right now, cash rent it back out, and keep the cash, is cash going to be king? It's always been king, but is it still king? Should I position less operating note, or not looking for financial advice here, but a lot of guys, they can hold, they can move money around so that they have more cash position. So when that deal comes up, you talked about Warren Buffett earlier, and I always think he says buy when everybody else is not. Now I sell farmland, and everybody else is starting to not. So do we buy now?
Well, great question. Let's talk about why cash is king. What does that really mean? And I think that comes back to working capital. And working capital is the original risk management tool. And what is working capital? It comes from the balance sheet. It's the difference between the liabilities we have to pay in the next year and the assets that we can convert to cash to pay those bills. And we talk about all these other risk management tools, ARC and PLC, crop insurance, but it's that working capital that helps us weather those downturns in the farm economy. And going to your earlier point, one of the trends that we've seen here is working capital at the sector level across all farms in the farm economy did not grow as quickly, and it did not get to the magnitude that we saw 10 years ago when farm incomes were also high. Not as high as they were recently. So we had higher farm incomes but lower working capital growth. And why did this happen? Well, there's a lot of reasons. Producers, like you said, might have been using more of their cash to buy equipment or land to avoid this interest expense from higher interest rates. And that might be a good strategy, but we just need to think about the trade-offs and the alternatives. And producers, I think, if you're going to weather a slowdown in the farm economy, if you're worried about this, working capital is that frontline defense. It's where we need to put some goals around and actually put some action behind that, growing that and maintaining our working capital positions.
Yeah, we saw a lot of... Sorry, go ahead.
I was just going to say, did you get all that, Corey?
A little bit.
All right.
I'm going to liquidate land because it's going to go down, and then I'm going to buy it when it goes back
Buy
down.
it when it comes back.
But you're right. When it comes to that working capital equation, as we sit in this moment, there was a lot of money spent for assets that also inflated in value very quickly in the ag sector. If you look at what a piece of machinery cost compared to the standard inflation, some of those values went extremely high, what land did over the last couple of years. So it's fascinating that all these factors come in together, but working capital is still going to be very important. But outside of the U.S., how are other economies affecting what's going to happen this growing season and down the road?
Well, it's a pretty open-ended question, so I'll narrow it in on a few of these. But I think the first one is thinking about, inflation is not just a U.S. problem. There are other countries around the world that are dealing with inflation, and we have this rising interest rate environment. And in fact, the U.S. has sort of led the pack when it comes to rising interest rates, and that's impacted the dollar, and it's been a bit of a strong dollar is not necessarily good for ag exports. Now we switch the page, we think about the Chinese economy and how it's been slow, and how that might be impacting their interest of stimulating the economy.
Yeah, there's a lot of things, like you said. It was a pretty broad question to begin with, but even when you go down to the food choices that individuals are making because of the economic status that they have in their own nation is affecting the demand we see currently today, right?
Yeah, there's three ways that we increase agricultural demand. We have a larger population, we have growing economies or more income per capita, and government policy. And so when we think about the China story, we sort of saw peak population was the headline a year ago and still relevant. The next piece is their economy has been slowing, but they're at this point where they're consuming a lot more beef and pork and just poultry, meat, poultry, all collectively, meat as a whole, protein. And so that's been a huge part of that. So is that going to slow down a little bit as their economy grows at a slower rate. It's all relative, right? A slow economy in China is, a pretty good economy here, 3, 4, 5% growth relative to 7. And so we're still anticipating to see growth out of China, just maybe not as aggressive as the past, but this move towards higher proteins, higher value proteins.
Well, you never want to go back. I mean, once you drive a Platinum, you don't want to go back to the XLT. Once you've had the Louis Vuitton of meat and you're in beef, man, you don't want to go back to rice or anything else, right?
And one of the things we've seen, even before they had the issue with the trade war and the African swine fever, is China's pork per capita consumption had stalled out a little bit because they started to substitute to beef. So there's two takeaways from that. Is one, we do have this substitute going on in China. The second one is demand in China isn't moving up and to the right for everything all the time. There reaches a point where there's only so much meat they're going to consume. Now they're moving up the value chain, not just more quantity.
Yeah, it is. It's neat for me, a guy that likes to geek out on the numbers, to see the statistics. And like you just said, it slid right by, up and to the right. That's a positive motion for a lot of people. But as we continue to look at the government relations that the U.S. has with other trading partners, what do you know about the U.S.-Mexico relationship, the U.S.-Canadian relationship? Do we see there being issues with that in their economies potentially affecting agriculture?
Well, our three biggest trade partners are our two neighbors in China. So we have U.S. and Canada and Mexico, and China are our three big allies there. And so we've been in a bit of a trade struggle with the NAFTA 2.0, USMCA. We're now trying to confront some issues with China on the corn situation. There's still some lingering dairy issues with Canada, but also this lingering, I don't know how to describe it. Both political parties have been tough on China in the last 8 or so years. That's about the only thing that D.C. can agree on. The administrations have had different approaches, but they've both been in the same direction. So I think the risk for agriculture is we're very vulnerable. In fact, I think it's really important that if the U.S. economy were to go into another trade war, a defined trade war with China, the U.S. economy is more insulated today than it was 5-6 years ago. Why? Well, the onshoring and the trends that are unfolding there. But I think U.S. agriculture is more vulnerable. China's buying just as much, if not more today, than they were before the trade war. And so we're still very vulnerable to that.
Is there a way to shelter ourselves from being reliant on other foreign entities and foreign trade? So Brazil took over as largest producer this last year. I think I heard that statistic. I might not be right, but that they're exporting more than we are. Okay, if they're exporting, can we become self-reliant just as the United States? That maybe it's ethanol, maybe it's corn stovers, maybe it's something else. Is there a way that we boost our economy without having to play nice with everybody else?
Well, that's a great question. There's a lot of threads that we can pull from that. So one of the threads is
sustainable jet fuel. Throw a buzzword out there.
Right. So there was about 6 months ago a flurry of articles talking about how we've lost our crown status as the top agricultural exporter in the world. And there's sort of a lot of lamenting around that. Well, one of those is a positive story around the domestic story. And the domestic story is we had renewable fuel standards, which is we took a whole bunch of our corn and we turned it into ethanol. And now we have biodiesel and we have renewable diesel and we have sustainable aviation fuel. And so I think one question for a producer to think about is, well, is it more valuable for does a farmer get more value when those products are used locally or whenever they're loaded on a train or a barge and shipped to a port and loaded on another ship and shipped around the world? So that's one angle to trade off. So yes, I think domestic consumption is how we start to insulate ourselves a little bit from that. The other thing that's been going back to that trend we talked about, there's a difference between shipping raw commodities and more refined or finished goods. So do we export the soybean or do we export the pork? And I think the U.S. has been in a position where we've been sort of selling more of our finished goods and less of our raw inputs. And I think that's just another way of thinking about how we can impact that trade story. Finally, unfortunately, a lot of the growth in agricultural demand is, especially when it comes to population and income, is exports. We think about a few years ago, we looked at this. The per capita or the total growth in U.S. meat consumption. And U.S. meat consumption is going to increase at like 0.1% annually, which means we're not going to see a huge change in U.S. beef consumption throughout any of our lifetimes. But China was increasing at 7.5% annually. So if you want to see your industry grow, you're going to have to tap into those export markets to really accelerate that. So 7.5% annually, you're going to double beef consumption in China, and that's the pace that they're on. That's the pace that they've been on for several years. So that's sort of this trade-off between growing domestically and taking off some of that risk versus trading to those export markets and taking advantage of those high-growth economies.
Corey, I don't want to talk over all our listeners' head. You're my farmer, and so does what China's consuming affect your decision-making and what you're planting this year?
Well,
I mean,
free markets would, yeah. If they're buying something and it's raising the market, that would affect my decision whether I plant corn or beans.
So, how much are our listeners studying foreign markets and where the trade is? And there's so much to know as a farmer. I'm worried about high-speed planter and is this chemical working and is this? Yeah. Here's something else I got to throw in the toolbox.
And I'm not studying it. I hear it daily on social media or from guys like David or even on farm shows on AM radio type deal. It's always a conversation in the marketing piece. Well, China's not buying, or they are buying, or it is a decision maker, but I don't know how much I weigh stuff on it.
All right, just kind of curious. What do you think our listeners do there, Tanner?
Well, I think there's all different levels. There's those that are taking advice. They're subscribing to Dave's program. They're going to use the insights that he shares with his partner and take that collectively into what their decisions are going to be. But ultimately, they want to raise the best commodity in the largest quantity that they can sell for the most money.
Mm-hmm. And then we hurt ourselves because we're really good at it, and we overproduce.
We do really good.
Yeah.
So, David, I want to kind of reframe maybe part of the conversation back to some other spots in history. We had the pleasure of going to Froberg Family Farms, and he was telling us history of his farm as to how it evolved from a strawberry farm that was bulk delivery, sold to grocery store chains. But then when the war happened, all their help was drafted. And they went into a labor shortage to where they went you-pick strawberries. And that kind of evolved their farm itself. What's the status of the labor market today in, around, and about agriculture?
Well, one of the covers that the Federal Reserve has had for raising interest rates as aggressively as they did over the last 2 months was this really low unemployment rate throughout the economy. And you look at the unemployment, it's, the lowest it's been since the 60s. And it was actually just as low before the pandemic. So before that peak and contraction during the 2020, we've had low unemployment throughout the entire economy. So let's drill this down a little bit further. Let's get closer to the farm economy. It's often the rural economies, the rural counties that have even tighter labor shortage. So you think about a 4% unemployment rate in the U.S. economy, wherever it's at today, it's around that 4%. It could be closer to 2% or 1.5% in some of these rural economies, which we think back of the envelope, 5.5%. It's that full employment. So it's a little tight when you get below 5%, and you get down to 1.5%, 2%. There's just not enough applicants. There's not enough qualified employees to fill those roles. So producers are having to think about this in a lot of different ways. How do I recruit from outside my existing labor market? Is there a way for me to bring folks in to work in the community that I'm in and operate in the community I am? Second of all is, do I get larger equipment? Can I somehow get more output from my current inputs of labor? And then also, the question that's on a lot of our minds is AI and autonomous, and how does that fit into this? But ultimately, this really tight U.S. labor market is going to be, and I think this is one of the economic challenges that we haven't quite put our finger on at the macro level, but I think it's going to be part of the macro story over the next several years.
I want to come back to the AI because we've talked about it every show and probably will here because it's getting bigger. But I could almost hear listeners probably screaming at the speakers when you said we have really low unemployment, because everywhere we go, whether we were in California 2 weeks ago, down at Froberg's, is, guys, we don't have any labor. We don't have any labor. It's hard farm labor. That's really not what most people are looking for.
Yeah.
So when do we get that back?
I think we go, I think, Tanner, me and you did a show on this on time management, and there was a couple things that they said. First off, what can we eliminate? So what can we eliminate off the farm? Second, what can we automate? right? So then we're getting into AI and automation and time management. And then the next one is now it comes back to me as the top dog operator. Now, what is important time management wise? Can it wait for tomorrow? So what can we eliminate? What can we automate? And then what can wait until I have the time to do it? So I think guys are just going to get more efficient with their time, and that's maybe where the AI piece comes in, to where people say that AI is going to take jobs. I don't know if it's going to take jobs. It's just going to fill the gap of where there are no jobs.
Fill the gap of where there's no labor.
Yeah.
The jobs are there. But it is something fascinating. We had an interview with the CTO or COO of
I'm the CTO.
Gus. You're the CTO.
No, you are, yeah.
It's an automated spray system for orchards and those high-value crops because they were struggling to find labor to spray. So now one operator can manage 4 spray units. They've created more efficiency through autonomy. We know that there are billions of dollars being spent in research to help create more efficiencies in agriculture. But as you look at the economic side of what these impacts have for agriculture going forward, when you identify a couple of key things going forward, what should we be focused on watching? What, in your opinion, for 2024 and 2025 to rebound, maybe we don't get back to 2022 levels, what are some key things that need to fall into place?
I'm going to back up here and go back to the labor because I think this is really important. And I'm going to get to your main question here. Is this labor situation is kind of like being chased by a bear. You don't have to be the fastest person in your group. You just have to be faster than the slowest person. And I go back to, I live in West Lafayette, Indiana, and there are just months and months of a sign on the Wendys saying, sorry, the dining room's closed because of a labor shortage. But sharing the parking lot was McDonald's, and their dining room was open the whole time. And I don't know what the labor pool looks like, but I'm guessing 2 fast food restaurants sharing a parking lot are tapping into the exact same labor pool. One of them was doing something well, and one of them was struggling. And I think one of the things is looking at the macroeconomic situation of a tight labor supply, low unemployment rates. We want to yell at this screen, but I think the levers that individuals listening to this can pull is, how do I get creative in the offerings that I have that I can recruit, retain, and train labor that really works for my operation? So I like to kind of flip that around a little bit and say, what can you do as an operation to improve your
So do you think that's not money related?
It's other. This question.
It's other things. It's housing. It's cars. It's time off. It's work remotely. Is it something else, or is it just money?
It's not yelling at your employees. It's all the above, right? It's how can you create an environment that is attractive in some of its wages, some
Corey,
of its hours of the day.
We got to work on Tanner. We need extra benefits.
Quit yelling at us.
Quit yelling at us.
That's not what I thought you were going to turn to me and say.
What are the benefits of working this deal?
But I like the Wendys scenario, to where I was trying to dive deeper into it, because COVID did a lot of things and changed the way life is for a lot of people. I almost wondered if they discovered that Wendys was more profitable when it was drive-through only and stopped hiring to keep their dining room open. They may have the number of employees necessary to operate, but it was a much more fluid operation. Same
Probably
thing,
right.
what we're identifying in agriculture is we might just be finding a better way to do something
We did that.
because of a situation we were forced into.
We had a full conference, and then we found a better way to do it and more efficient.
We
that
go to
people
everybody
like
else's
more.
conferences.
We'll go to everybody else's conference and just record a podcast.
So yeah, back to I'm glad that you took the time to communicate on labor. So let's go back to that question about what are you seeing for the future of some key things that could be tipping points.
Well, what we're watching here is ending stocks for all of our major commodities are starting to move from this really tight situation we had a year ago or 18 months ago to this is enough corn, 15% stocks to use is starting to get abundant. And if we raise the crops that the USDA had on this back of the envelope projections a few weeks ago, it's going to be burdensome. And so we have to really watch this supply story. I think ultimately we also have to watch the demand. When we look at this, usage has been below a trend line pace. And so it's been consistent where we've been the last 5 or 6 years, but we need to see growth. We need to see these headlines of record corn usage, record soybean usage, because when we're raising record crops, we have to have record usage to offset that. And so we need to see and as an economist thing I worry about, it's the cure for low prices is low prices. But the question is, how low do those prices have to get that U.S. usage story back up? Soybeans are benefiting from that domestic crush element. We're starting to see some export activity increase for corn, but is it enough for us to chew through these stocks? And I guess I don't think I can underemphasize this a lot. It's the interest rate environment. And I think that we often think about it when it comes to interest payments and our payments for buying a new piece of equipment or a new farm, but ultimately asset values are the biggest uncertainty. When we have 10-year treasuries at 4.5% to 5%, and we have the cap rates, or that relationship between cash rent and farmland values hovering around 2 to 2.5%, that creates a gap there. Is a lot of pressure on farmland values. So how is that gap? Is it closing or is it widening as we move forward?
So we have to, you said low prices cure low prices. We don't have enough demand yet, so we have to keep lowering the price to make it feel like they're getting a bargain or they can make money with whatever they're buying it for.
Or can you just make more demand? So
We
the
gotta find it.
government policy for more.
That's what he said is one item is it can be triggered by government
It
policy.
can be triggered by government policy.
Maybe you
and say,
shouldn't plant your field that you bought, Dave.
Yeah.
There you go. Take one for the
CRP.
team.
There you
I
go.
could just put that in. Hey, give me a payment.
wait for your check.
That
So
is
there's-
interesting.
There's two great icons in global agriculture. One of them is Norman Borlaug, who increased productivity and saved a lot of lives. And the other one's George Washington Carver, who found new uses for the peanut that allowed us to create new sources of demand. And I think when we go through our agricultural career, there's going to be times where we need more Norman Borlaugs. There are times where we need more George Washington Carvers to create this demand. And unfortunately, the pendulum is starting to swing where it's okay, the feeding the world situations, we got the handle on that. We need to figure out now how are we going to get the right demand sources to come online and fill in what we need. But when we step back a little bit, we think about U.S. major crops. One thing to keep in mind as a producer is soybean usage and oilseed usage is the strongest over the last 5 to 10 years. Corn is behind that, and wheat. Actually, when we look at wheat at the global level, wheat usage has been slower than yield gains. What does that mean? We need fewer acres of global wheat every single year.
It's because everybody has a
satisfy
gluten
usage.
allergy.
That's when he said peanuts. I was like, everyone's got peanuts out there. I was like, I can't have a peanut butter jelly at daycare.
But when we think about the
Yep.
future of our operations, oilseeds is in the driver's seat at the moment, and corn's right behind it, but it's oilseeds. And so how are we going to see more oilseeds come online, and where are the usage for all those crushed products?
As you said, feeding the world. I mean, 10 years ago, you couldn't go to a place like this without seeing that on every other booth. We got to feed 50 billion by 2050 or whatever the number was. I don't hear it at all anymore.
So one of the stories that came out of conversations after escaping 1980, that podcast, and we talked about that. As a producer, if you just sit back and listen to the crowds, right? There's this feeding the world crowd, and there's this what are we going to do with all this demand, all this usage? We don't have enough demand crowd. And those are sort of indicators of which side of history the pendulum has swung. And one of the stories that came out was in the 70s, there was this similar how are we going to feed the world idea whenever we had the USSR stole the U.S. wheat crop in 1972, and we had food inflation. And so I think it's just important for producers to recognize this pendulum swing, and that helps guide us or tell us where we are in the farm economy, where we are in this business cycle, and what kind of decisions we're going to be having to make ahead of us.
Yeah, was that also when they said plant fence row to fence row?
That was, yeah, so that 1972 is when they brokered the deal with the USSR. And then the 1973 Farm Bill is whenever they, interestingly, so a couple interesting things came out. They stole the wheat crop that fall of 72. We got the WASDE reports in 1973. And so that was, the goal of that was we want to have a global picture of what's going on. The other one was those flash export sales that we see on Twitter all the time. They said if you're exporting U.S. grain, you have to report it in a certain time frame. And that's where those get reported. And then, of course, Earl Butz, started making those comments around fence row to fence row. It's hard to nail down where exactly he made that comment, but that was the vibe. That was the mantra of what was going on there.
And it happens, except for now we take our fences out.
I know some farmers that quite literally take that literally, and it's almost to the road now.
Yeah.
Well-
and then the county comes in and mows it down because you can't see.
Well, let's talk about what that really means for producers. When we get to those strong profitable periods like the early 1970s and the 2010, 11, 12, 13 and the 2020 to 2022 period, when there are economic profits, how do we overproduce eventually? We increase agricultural output around the world. We make a bigger factory. And so we see acreage expansion that takes place around the world. Of course, they're not making more farmland. It's good investment because they're not making any more of it. Well, from an economist standpoint, we find new ways of farming land. And so we double crop, we get closer to the bottom of the ditches, we take CRP out here in the U.S., but in South America and in the former Soviet Union, they find other ways of bringing new agricultural land in production. So that's part of this business cycle. Is when we have strong profits, producers bring new acres online.
Corey, do you think any producers are going to see declining commodity prices in corn and beans and change how they're doing it? I mean, we just had a conversation about organic. Maybe we go this route. We were just out in California. Here's high-value crops. Hey, maybe we make it a vineyard. We saw people do agritourism this last week. Maybe we don't make our money on corn. We see where the bill's paid, and it's over here with the million people that come. Do you think people just find more clever ways? You know, he's talking about gaining more acres, but maybe we just find a better way to make money.
Well, there's simple changes like switching from corn to beans or something like that, you know. And I know that some people. I had a we custom farm for an operator that wanted to do all corn last week. Actually, we're going to go beans. Didn't want to deal with the expenses and all that, and so that's an easy change. The organic one, that's a 2 or 3 year time frame and a lot more labor and maybe some special equipment that you don't have and things of that nature. It does. It affects it.
I don't know if we have an influx of different crops.
I mean, that's what the market's trying to do right now, right? It's trying to make you make a decision of what you're going to plant, because we don't need 94 million acres of corn again when we have, like you said, the carryouts that are huge or big and growing. So we need to get rid of it or plant less.
It's usually those lean periods where we start hearing conversations about that next silver bullet, that crop that's just on the cusp, like, you know, switchgrass was going to be during the ethanol boom, right? That cellulosic ethanol was going to save the farm economy. We had hemp conversations 5-6 years ago. And if you just keep going back in the Rolodex, there are always these, these crops that we put a lot of hope on that they're going to save the farm economy. And I think for producers, they have to be, like Corey was saying, responding to the conditions that they're facing in their market. What are the levers that they can pull? Less corn, less soybeans, maybe more hay or more other alternatives that are local. Maybe it's a small grains like wheat or chickpeas or wherever they're at. Instead of sort of betting on and waiting on and hoping on this sort of miracle to show up and save the farm.
Maybe if you're a seed dealer, you just call it the money crop, and it really just gives you crappier yields. So then we don't have the overflow of what it is.
We already established it. You're just not planting your field, Dave. You're taking one for the team.
I guess that we're taking one for the team.
Maybe there should be a mystery bag of seed. We're going to price it here. It's a mystery.
That's right.
We'll tell you what the seeding rate is. We're not going to tell you what the seed is.
So we had an interview with a gentleman that managed a hedge fund farming operation in Ukraine and Russia and just parts of that area. And it was interesting to find out that some of those landowners, because he'd have like 100,000 different landlords over the process of this, because everybody was given a portion of land and everybody was told what they could raise and how much they could do. That's not the direction we want to go in United States agriculture. We don't want to be given a mystery bag of seed, and you might have the poor yielding crop this year, or you might have the good yielding crop, and it's up to the government to decide.
That's a really important distinction, is that we have this market. Unfortunately, the market can be brutal, and the market can take some time to resolve itself or to find that equilibrium. But ultimately, producers have got to be in a position to make the best decision for their operation with what's ahead of them.
That's right. Well, do you have anything else you want to share with our listeners before we wrap up and close out this conversation today?
I got one more question before we wrap up. Maybe this will end us good. And Tanner, it's your question here. It's looking ahead, what do you see as the most promising opportunities in the future?
Well, that's a really great question. I think the bright spot, if there's a bright spot here in commodities, is soybeans in North America, or soybeans in the United States, oil seeds globally. And so we got to keep an eye on how we can respond and develop that demand and be responsive to that, and see how that, sustainable aviation fuel is that long off dream, but there's real actual trends underway. One of the things we've seen is that soybean oil going to biofuels has been a trend that started back in 2014 and 15. It's been playing out for several years, so there's some long legs to that. If you're a producer listening to this, what are some of the things that you can do on your operation? And I think it's this is kind of hard to wrap thinking around, but a higher interest rate environment means that we will be able to buy assets that get us a higher rate of return. And so there's this hard line of thinking about what's the right interest rates. So if we're borrowing money, we want it to be zero. If we're buying assets, we want it to be high. And so I think producers just need to step back and think about, what am I doing on my operation that can get me a high ROI? That's maybe the wrong way of thinking about it. What gets me a high return on that asset is maybe a better way of thinking about that.
Money's made in the margins.
And so maybe there are activities or there are assets that we were doing in that 2010 to 2020 period that was a low return activity. Maybe we're going to be able to have more higher return activities looking forward. Again, that's kind of a difficult thing to think about when we're in a rising interest rate environment. But on the other side of that, we might be able to have some comfort around that.
Mm-hmm. So it's going to be a difficult episode to summarize, but I'm going to try and do my best because we are not in the 80s. We, again, have tried to compare ourselves to one of the worst economic times in the history of agriculture, and we're not there. But we aren't as good as some of the best times in agriculture, which was 2022. Corey obviously has a lot of firsthand experience with that, as do our listeners. We're in a very interesting interest rate environment to where we're going to have to pay attention to what the Fed's going to do. We know that short-term rates have higher odds of decreasing in the near-term future than that of long-term. Probably going to see when and if that happens, the interest rate inversion switch, because longer-term rates are going to be sticky or may hold in that position for a little bit longer and lag to get that inversion back corrected. We do know that the state of agriculture right now is we've got a lot of supply. And we need to build up demand, whether that is geopolitically or through government incentivized programs, trade, or what was the third one?
Population and income.
Population and income, yep. So that is certainly something that we're all going to pay attention to. And, of course, a natural disaster could create a lower supply issue. And all of a sudden our surplus, our ending stocks that have been increasing and the padding that we've had, the cushion, could go away completely. We know that there are population stall out for growth in China. We also know that their economy is slowing down. It's not going in reverse. But those are going to be factors that also affect what we have going on. And then we do have some bright sides. You know, the future of some of the labor solving issues, whether it's through automation or through efficiencies in agriculture. We also know that there are other demand sources being created and tested and rolled out for products that we have domestically. And we also know that there's a stronger taste for protein. So the fact that we can export maybe more finished goods rather than raw goods to help benefit the pocketbooks of our listeners in agriculture. But ultimately, we have to take all this information in, and it might be good to have somebody like David on your team to analyze this and provide some additional insights. So if our listeners do want to learn more about what you do and maybe connect with you to look at their operation, how best do they do that?
Check out our website, aei.ag or aei.ag. We're also on social media. But that's exactly what we try to do. We're trying to think about this farm management space and what are the tools and the insights and the data that can help producers make better decisions on the farm, despite the uncertainty that we're all facing. I'll wrap this up or share my final thought here, if that's okay.
Absolutely.
And it's this idea that I was just reading a book the other day. Is like, as decision makers, we have to be optimistic about the future, but we also have to be realistic about the challenges that are right in front of our face. And so I think one of the things that we talked about today is some of those challenges. And that doesn't mean we're pessimistic about agriculture. I think all of us here at the table are very optimistic, and the listeners are very optimistic. But we have to be able to size those challenges up that we have in front of us. And so we have a few challenges, a few blocks that might keep us from getting to those goals that we have set for ourselves in the next 5 to 10 years. But we're still optimistic about the long run.
Well, that's good. Which one of you guys wants to challenge our listeners?
I had one more question pop up because that's what I do.
Perfect.
A farmer looks at the markets several times a day, maybe even at night now that night markets all that. What do you watch for all this? Like, what is something you check daily or multiple times a day?
Okay, this is a little bit controversial. I try to limit the information that I consume that expires within a few minutes. And so I think about the shelf life of the information that I'm consuming. So if I check the markets, how long is that information going to be about for? Now, I'm not marketing grain like a producer does on a regular basis, but my recommendation in that case is like, put some targets in, put some orders in, and not get caught up because there's markets up, markets down, there's a narrative as to why that happened. I'm trying to spend a lot of my time thinking about how can I consume ideas and data and knowledge that has a shelf life that's valid for a few weeks, a few months, a few years. It's reading more books and less social media. It's, looking at the long run trends versus the year over year changes. That's what I'm trying to challenge myself on.
That's a good answer.
Yeah.
That was a great answer.
There's your challenge, yeah. Right there. He just said it. Study the data to help you make better decisions. So that's your challenge. You've got a lot of decisions to make in up times, down times, and it's going to be more crucial in the decision you make. It's going to have more weight because that margin is going to get thinner. And so as that margin gets thinner, be very cognizant with your decision making. So that's my first challenge. My second challenge is for Tanner to do a summary, but he only gets 10 words. We're going to have to try that. It
wouldn't have
was
worked.
Could
we have AI that's
better
listening to the show as we do it and be like, give us a summary for the last 50 minutes?
Give us a summary.
Guys,
Yeah.
Be
AI.
better.
You could put this whole thing into AI
Oh, yeah.
and have ChatGPT spit out a 10-word summary.
But now I want it real time.
Real time.
As we're doing it. Keep building that summary.
I'm sure somebody will sell you something.
Yeah.
The way I like to summarize this, and I like to encourage producers, is 2 words: stay curious. I
There you
think
go.
if we stay curious, it avoids a lot of the pitfalls in decision making.
Yeah, this is great. I appreciate the opportunity to meet you in person. I appreciate you coming back and spending a good portion of your day with us today. Thank you a lot. Listeners, we also thank you and appreciate you tuning in. Hopefully you found value in this episode. If so, please share it with your family and friends and neighbors. But until next time, have a good one.